So, ladies and gentlemen, good morning, good afternoon, and good evening for all of you following up. As we wait for the more participants to come in from those registered, it is my pleasure to open this webinar on the series of the eGFRID, which we call the Virtual Global Forum on Remittances, Investment and Development, dedicated to remittances in time of crisis, response, recovery, and resilience. You are free to obviously to follow some of the events that were held previously at the link that you have in front of you. But this one is the 9th edition of this that address remittances and investment, how migrants finance sustainable development. I am Pedro de Vasconcelos. I'm the manager of the financing facility for remittances here at the International Fund for Agricultural Development. I will be your host / moderator and friend of all our panelists today to try to involve in this discussions, ongoing discussions about migrant contributions to development. Today, it's a very specific and a special day because we're going to go back a little bit and then we're going to dig deeper. So it's a little bit of a different approach, but we will look on how initiatives have contributed to support migrant contributions to development. We will look particularly at operations through a study commissioned by the European Commission, which will be followed then by a panel of practitioners, most from the private sector, actually almost all, if I'm not wrong, from the private sectors, and they will be able to give you a view on how they see these activities that we discuss oftentimes about how migrants contribute. But before we dig into the fact of the matter, one aspect that I think that is important to highlight is the fact that we've divided this discussion into two pillars, because when we talk about migrant contributions, these are many. And one is the remittance families, has to do with everything related to remittances, and it's the combination of the migrant and their families. It's that $200 that is sent every month. And on the other, we'll look at diaspora impact investment. Diasporas that might be migrant workers with families or no families, but still with a connection with their hometowns and communities, and to which they provide support. These are two different types of flows. Sometimes they come from the same pocket, but in this case, operationally, we're going to look at that differently, and we will illustrate this with our panelists, and the study will do that. On remittances, we'll be looking at basically access and use, and that translates in a nutshell about getting the money there faster, safer, and efficiently, as the SDG 10C calls, reduction of cost of remittances and getting remittances there. And then use is to make a bigger bang for the buck, basically. When remittances get there, in the hands of families, how can you have a multiplier effect? What can be done? And that basically has to do with the potential for financial inclusion, linking this with savings, credit, insurance. That's the development impact that remittance can have in a nutshell. On diaspora impact investment, I say impact investment because this impact investment has been coined in 2007, I think at the Bellagio Rockefeller Foundation meeting. But diasporas have been doing impact investment much before any bank ever dreamed about linking social outputs with their returns. And this is a thing that we need to look into that. How can we make this mechanism easier for them? And really not only address this, but really put it on the map, because the aggregated amounts are immense, the impact is huge. So these are the two areas that we will be discussing today. And it is therefore my pleasure to present our panel today. So if we can have a presentation slide on the panels that we will be, the panelists that we will be presenting. Apart me, we will open the forum with Francesco Luciani. He's the head of unit migration and forced displacement at the European Commission. We're then going to have our three presenters for the study, Simon, Sona, and Stefan. As you can see on the screen from the European Commission Joint Research Center, but also Stefan is a Principal Research Fellow and Overseas Development Institute. Then our panelists, we have 4 panelists today to address both remittances and diaspora investment. First, we will have, in 2 rounds of discussions, we will have Nika. She is the Director of Strategic Projects at MFS Africa. We'll have Michael. that is the Managing Director Microinsurance Center at Milliman, addressing remittances and insurance. We will have Alina. She's the Director of Non-Bank Credit Department at National Commission for Financial Markets of the Republic of Moldova. And last but not least, we will have Mamadou, who is the Program Manager at Investisseurs and Partenaires, who will address more into the aspect of diaspora impact investment models. So this is our panels for today. We have an hour and a half for this presentation, followed by the discussion. We will leave some time at the end for questions and answers. You are free, of course, to start typing those into the chat. We are going to monitor them, block them. Please do say if to whom you would like to address this question, if anybody in particular, and we will try to convey. Last but not least, any unanswered question will be answered in the website that was presented at the beginning of this webinar. We will ask kindly our panelists. They will take the time after the event to propose an answer and even share links for this. And therefore, we want to make sure that you go satisfied with that. And obviously, this will still be a possibility after the event if something comes to mind, or if you see this particular video that is being recorded later on. So without further ado, let us start with the bulk of the matter. It's my pleasure to introduce you to Francesco Luciani, which I give the floor now for his opening remarks on this webinar. Francesco, the floor is all yours.
Many thanks, Pedro. It's my pleasure to join you today on behalf of the European Union for the opening of this webinar on the Global Forum on Remittances, Investment and Development, organized by IFAD and with the support of the EU Joint Research Center. The European Commission, more specifically its Development Assistance Department that I represent, has been the first financial supporter of IFAD, the Finance Facility of Remittances that you're leading, Pedro, contributing to its creation in 2007. Since then, we have always partnered with IFAD and other stakeholders to address the multiple challenges facing migrants sending remittances back to their home countries. This is a very important area of work, and we understand it every day more. Because globally, remittances directly matter now, approximately for 1 billion people across the world, according to some estimates. 200 million migrant workers send a share of their earnings to help feed, shelter, educate, and support back home the health and all life, addressing all life needs of estimated 800 million family members in more than 125 developing nations. This is quite huge. This is enormous. Remittances are very important for all of them, but remittances are very important for the European Union as well, particularly for the International Partnership Directorate General, where I work, where I lead the unit of migration and forces placement. We are increasingly aware of their importance. We are increasingly integrating them in our reflection, thinking, and work. We are very much aware of the fact that their magnitude and their impact can be much more of the official development assistance involved. Of course, they are dispersed. They are in thousands of private channels, and it is private money, not used necessarily automatically and in a directive manner. Indeed, it's different from the ODA, but nevertheless, has a huge impact, much stronger, sometimes also much impactful and direct than all the development assistance, public development assistance that we promote. The European Union is needs to be stressed, is the second largest remittances sender developing countries in the world after the USA. Remittances from the EU have a truly global outreach. We estimate that around 105 million people in developing countries are benefiting from the remittances sent from the EU. The European Union, in its multilateral commitments under the Agenda 2030, the EU consensus on development, that is the policy document that translated the agenda into our EU policy, and the Global Compact on Migration, of course, is committed to promote cheaper, faster, and more secure remittances, and to enhance the development impact of remittances in their destination countries. And to that end, the European Commission is working also to accelerate the digitalization of remittances and investment schemes via formal channels to make remittances a key component also for the post-COVID-19 economic recovery in developing countries. We are trying to fulfill the SDG 10 objective on reducing remittances cost to 3% at EU level. We are aware that should we be able to reach these objectives, migrants in the EU and their family and friends at home would save an additional €1.5 billion in transaction fees every year. That's really huge, and it's worth really trying to reach this objective. In terms of pricing from the EU, there has been a gradual decrease. So we are going in the right direction. In 2015, the average cost in the EU was 7.55%, while in 2020, the average cost had come down up to 6.47%, which is still far from the 3%, but nevertheless is already better than the global average. In any case, the progress was differentiated from region to region, and the biggest one was took place in the corridor between Europe and Africa, which, by the way, for us is the most important one, where we registered a decline of 30% in the transaction fees in 5 years. In view of these results, the attention could start focusing more on how to harness and leverage remittances for greater development impacts. This is the other aspect that you, Pedro, was also mentioning at the beginning. The importance to make the best possible use of the remittances funds for development impact. There is an overall international effort to ensure that the money goes not just to consumption and to covering running costs, which of course is the priority for most of the families, and in many cases the only thing that they manage to do with the limited savings and remittances they have. The effort is, of course, to use what can be saved for productive investments. This is, of course, not an easy task. It depends also on the skills of the person and on the literacy of the person, financial literacy, and also the development opportunities at country level, and also by the context, also how the authorities in the origin countries behave. I would say it doesn't depend just on the sending countries. And it's clear also that there are serious gaps in what is being done. I mean, many things needs to be done, and we are still not managed to achieve better results. But we will continue working on that, and we will look forward to set up a diaspora investments mechanism, and to that end, we will also see how to produce what is indispensable mean. Sometimes new financial products are needed, and some exist. Some financial regulatory frameworks need to be improved, and also financial systems need to be promoted. So there are a number of actions that need to be done on specific level, but also at systemic level. Last year, on June 16, 2021, the Knowledge Center on Migration and Development of the European Commission Joint Research Center launched a global report, and the colleagues are there and will speak about that, of course. That's one of the focus of the seminar today. Launched the global report mapping migrants' investments schemes throughout the world. The objective was to facilitate the scaling up of initiatives to leverage the potential of migrants' financial investment in order to meet operational and methodological challenges. Our colleagues from the KSND are presenting today the report, and they do welcome the collaboration with IFAD. This webinar is a clear evidence of the EU-IFAD partnership on remittances that is based on mutual knowledge and strategic exchanges, going beyond the fund, because here it's also a exchange of knowledge and strengthening joint initiatives also at political level. I conclude by saying that the European Commission is willing to build on and expand its current initiatives on leveraging remittances for development and fostering diaspora investments. The JRC research maps as particularly promising match funding schemes involving migrant and diaspora entrepreneurs and incorporating knowledge exchange and training components seem promising avenues for small and medium enterprise. We don't start from the scratch. There are hundreds of initiatives ongoing from which we can learn, and this seminar can help indeed share best practices and maybe create joint initiatives, who knows. So I do welcome again this webinar as a space to support the building of a consensus based on data collection and evaluation in order to better inform future policy and practice. I wish you a very good discussion and collaboration. Thanks, Pedro, and back to
Thank you. Thank you so much, Francesco, for couldn't be better said. I think you cover very well in terms of background, why we're here today, what is the next step, what is on our agenda. So this really sets the floor, I believe, for my colleagues of the European Commission Joint Research Center and the Overseas Development Institute for your presentations. So without further ado, I will give you the floor, and we're going to be putting also the presentation as soon as you request so. So you have the floor for the Diaspora Finance for Development from Remittances to Investor.
Thank you very much, Pedro. Could Alessandra, could you put this? So as Francesca and Pedro have mentioned, this is a paper report which the European Commission published last June and was produced by the Commission's Joint Research Center and my own institute, ODI, which is an independent global affairs and international development think tank in London. Could we move to the next slide, please? Thanks. So our report is really trying to make one major point, and that is that when we think about diaspora finance, we need to think not only about remittances, but also about what we call diaspora investment. And there's two important reasons for this broadening of the scope of our thinking and our practice globally. The first is we need to move from migrants to diasporas, which is a much larger community, including migrants as well as their descendants. It's a self-defined group. In other words, it includes people who have some sort of emotional, affective, or national connection with their country of origin or the country of origin of their ancestors. It's important to think about this because people may be more willing to invest in their country of origin. There may be what we call in this arena a patriotic discount. And they may also have advantages in investing in terms of the information they have about the economy that they're investing in and in terms of the business networks and other networks in that country. So that's the first broadening from migrants to diasporas. The second, from remittances to diaspora investments. The important point here is that we're thinking about a much larger pool of funds, of finance, than is only referred to in relation to remittances. We're talking here about, in addition, the savings and the wealth of the migrants as well as the diaspora, which may be a much larger set of, a much larger pool of funds. And as we will show in our presentation and in our report, there's a very wide range of diaspora-specific mechanisms which are already at work in many countries around the world. So we need to look more closely at this issue. There's no systematic data, there's no coherent framework, either official or semi-official, that exists to look at this. And so we took a first step in doing this by identifying 250 odd diaspora investment mechanisms based on an initial collection of over 500 documents in 7 languages. And this database is now available on the JRC website. The next slide, please. In this table, we spell out in fairly stark, clear black and white form, if you like, the differences between remittances and diaspora investments. So in the first row, you see monetary flows. For remittances, the flow is one way from the sender to the recipient, whereas for diaspora investments, there's a two-way flow in the sense that the sender who's investing their savings expects some kind of a return on their investment, a financial return. The next row talks about the senders, migrants on the one hand versus the diaspora on the other, migrants plus later generations. Then we have the recipients, which in the case of remittances is households and community organizations primarily, but in the case of diaspora investment is mostly not households. It's firms or businesses, enterprises in the country of origin, government and public agencies, and also NGOs and social enterprises. The links between the sender and the recipient are often very different. In the one case, direct and interpersonal links. In the case of diaspora investment, mostly indirect and impersonal links. The sender does not know the recipient, who often, of course, is not a person or not a family. And then the transaction type in the last row also differs. In the one case, it's what we would formally call a gift because there's no transfer of property. But in the case of remittances, whereas in the case of diaspora investment, we're looking at the creation of a financial asset and the transfer of that asset as a piece of property which entitles the owner to a return or to some kind of financial income or return on their investment. Next slide, please. In this slide, we just try to highlight some important differences in the process. In the top channel, we have the remittances process where money goes from the migrant household sender through a money transfer agent to the recipient household and then is spent in the country of origin. But in the lower channel of diaspora investment, we have the sender being a saver who then transfers money to a financial intermediary, a financial institution, or an agent in a financial market, who then in turn transfers it to an enterprise or a firm or a public agency receiving the money in the country of origin, and then it is invested in the country of origin. And the arrow at the bottom underlines the fact that there's a return flow, a two-way flow of money, where the provider of the money, the saver in the country of residence, is looking for some kind of financial income on their transfer, even though they may have the connection with the country of origin where they're investing. Next slide, please. In this slide, we simply outline the different types of mechanism which apply in remittances and in diaspora investment. So on the left, we have three different types of remittance mechanisms: individual remittances, collective remittances, where money is collected from a group of migrants before being sent to an organization in the country of origin. And lastly, philanthropy, which is wealthy migrants donating money to their country of origin. And then on the right-hand side, we have diaspora investment mechanisms, which the first three take the sort of standard financial asset types of equity or ownership shares in a company. Then we have loans between lender and borrower. And lastly, bonds, which are a form of a fixed amount loan with a fixed interest payment, usually a long-term type of loan made not by a bank, but by other financial investors. And then we also have added in a fourth type of diaspora investment, which are knowledge-focused mechanisms, which often will accompany the other financial transfers, but also in many cases will not be accompanied by financial transfers. So these will be spelled out in a more detail in the next slides, and I hand over to Sona to continue. Thank you. Next slide.
Hi, everybody. Yeah, building on the background, the theoretical one Stephen just presented, we started to go through the document we have initially collected, and overall we reviewed more than 500 documents, which enables us to identify 329 different diaspora finance initiatives. This means that we have been able to find in this reference document evidence for each of these initiatives we have collected and now also published in our database. However, out of these 329 initiatives, not all of them were containing enough information to be included in our dataset, because we were looking for information in terms of the geography, in terms of where the flows originate and where they are directed to, which are the assets produced, the underpinning mechanism, but also who are the providers of these funds, beneficiaries, and also the facilitating intermediary institutions or organizations. So this is to say that for some of these initiatives, for which we were not able to identify most of these indicators, the evidence was thin, we excluded them, and we remained with more robust but containing 254 initiatives for which we have enough evidence to analyze in our study. These 254 initiatives were involving 54 sending countries and 93 receiving countries. And we found out that all continents were involved in this process. However, they were not, of course, evenly distributed. In terms of sending, the regions with the most diaspora initiatives, where the most of the diaspora initiatives were originating, were the Americas, the Northern America mostly, and also European Union. And for European Union, we identified around 37, exactly 37 initiatives. This highlights that Northern America and EU member states are playing an important role in originating these diaspora finance flows. And we have also acknowledged that through our review, despite the fact that, as Stephen mentioned, we used 7 languages, which included the English, Spanish, French, Arabic, Russian, and Mandarin, we were not very successful in identifying the initiatives that were about the diaspora financial flows that are coming from Russia, and also for Gulf countries, which either they were not presented, they are not documented, or there is more room for research, and we would welcome anybody's collaboration on that. In terms of receiving, there is also not even distribution, obviously. The majority of identified initiatives are directed towards African countries. These are 97 initiatives, followed by Asia, 69 initiatives, and Americas, 58 initiatives, and most of them are in South and Central America and Caribbean. Also, in terms of countries, the diaspora initiatives receiving countries were not evenly distributed. We can see that the most of diaspora initiatives are going towards India, Ghana, Mexico, Kenya, Ethiopia, and Philippines. And there is an interesting pattern we also identified, is the majority of initiatives are originating from high-income countries, and they are directed towards upper middle income and middle income countries. This also mirrors the migration flows we are observing in the last decade, when we saw the shift from high-income countries to middle-income countries in terms of origin, and they are mostly directing these flows of migrants towards high-income countries. We have also studied the underpinning mechanisms in these identified initiatives, and we realized that the largest group of these mechanisms were focused on knowledge exchange. Initially, we exclude all the mechanisms that would include knowledge, but then later we realized during the while conducting the study that this was a very important element. And while we were not purposefully looking for the mechanisms that were about knowledge exchange, the fact that they are often come across the literature that we were looking for through indicates that they are playing an important role, and they are somehow accompanying these financial flows, enabling them and making this investment productive in the countries of origin. Also, the fact that they are so numerous might be explained that they are relatively not expensive and accessible both for the diaspora and countries of origin business community. From the remaining initiatives, the next most common type of mechanism that we identified were related to remittance-based mechanisms. They were quite spread, about 46 of them, half of them coming like collective remittance initiatives and half like social investments. The next common mechanism was equity-based mechanisms, 44 initiatives. And here we identified both diaspora direct investments and diaspora portfolio investments. Finally, we have identified less frequent but not less important set of initiatives which were related to loans and bonds. And here it is important to mention that while they are less frequent, that doesn't mean that they are mobilizing less financial resources. So the frequency of initiative doesn't necessarily reflect the amount that they overall mobilized. Next slide, please. In the study, we have also looked at the sectors of where these investments were directed. For the sake of time, we do not go into that, but also there we see that almost all the sectors were involved, and those interested in the study can go and check it. Maybe one thing that worth mentioning is that the most frequent sectors receiving these investments or diaspora financial flows were related to healthcare sector and education, followed by finance and insurance and real estate. At the very beginning of our study, we were very ambitious about the type of information we can collect, and we were hoping very much that we will be able to identify also the outcomes of this project. However, we quickly realized that the evidence on the outcomes and mobilized resources and long-term impact of these initiatives were extremely limited. This can be also be explained that there is no systematic review of this, or there is no methodology to report it necessarily. And we found out that we thought that even in cases where we have identified the outcomes, the evidence is perhaps biased because there is a self-selection among the initiatives that report these outcomes. We will have only the best ones reporting their outcomes, and hence that would not represent the general picture of the universe of initiatives we identify. However, the evidence was a bit more rich when we looked at the objectives, because often the case, these 500 pieces would include also the leaflets or prospects related to these financial diaspora investment initiatives, and they would state the objectives to attract the potential customers or investors to this initiatives or projects. So we were able, for half of the initiatives we have identified, we found that in half of them there were reported objectives, and they could be reported more than one objectives per initiative. We tried to group them to synthesize the objectives and the expected outcomes from the implementation of this project and into 6 groups. The first and most commonly met one, the most commonly the incidence of coming across this type of objectives, was the one related to enterprise development, or in general improving the economic productivity in the countries of origin. And this could be also related to knowledge availability to these initiatives, and also preparation of individual diaspora members to investments in the countries of origin, the startup scaling up of these activities. The second one, the most frequent, the next 3 ones are relatively equally distributed. In 20% of the cases, we would meet one of these at least. And that was, the first one was the knowledge exchange, which was mostly about creating this, developing the platforms to improve the knowledge exchange and networking between diaspora members and the business community of countries of origin. This was followed by the economic inclusion, which was mostly initiative that aim at creating employment opportunities in the countries of origin, developing skills, but also contributing to improving the financial literacy of the population or the business community in the countries of origin. And there was also related to inequality reduction by promoting social, political, and economic development in the countries of origin. Finally, the last two objectives that were related to infrastructure investment, public investment, including those in the infrastructure, and also those perceiving the objectives of improving the macroeconomic stabilities were mostly related to production of bonds or infrastructure projects such as Ethiopia Renaissance Dam or Nigeria Diaspora Bond. Again, these last two, while less frequently appearing in the database, does not necessarily attract less resources, because they are the huge project that attract large resources and involve a big number of diaspora members. With this, I will pass to Simon. Thanks.
Thank you, Sona. If we could go on to the next slide. So my point here is to move beyond what the different initiatives that we found do to thinking around how they're structured and how they work in practice. Here we're taking quite a high level because of the breadth of the examination that we did, but also because of the type of information we were able to gather, as Stephen and Sona have already described. In the four different charts, we map where the funds come from, so the suppliers of the funds, and the beneficiaries, so where the funds were going to as well for the different mechanisms that we pointed out. As you can see, the blue bar is highest in all of the cases for the supplier, which means that they're coming from civil society. So this is it. Funds are originating from individuals, from individual diaspora members or investors, or civil society organizations. We're talking about diaspora associations, hometown groups, and so on. This is not a surprise because it's how diaspora finance works. However, if we switch to looking at the beneficiary bars, we can see that different mechanisms are used to transfer the money to different audiences and different groups of people and organizations in the country of origin. So in the case of remittance-based mechanisms, for example, collective remittances, the beneficiaries are primarily civil society organizations as well. So we're talking here about hometown associations and community groups, which are able to use that to develop their local towns and villages and so on. We're thinking of the 3-for-1 mechanism, for example, in Mexico. Equity-based mechanisms, we can see the beneficiary is nearly always the private sector. And here we're talking especially about small and medium enterprises which need the money to start up or to enlarge, to continue their activities over time. In the case of loans, we have a slightly more varied picture where some of it is going to the private sector, and some of it is going to individuals, some of it's going to public sector. This is partly because of the nature of the different mechanisms within here. So we have individual loans, for example, for insurance mechanisms or for buying a house in the country of origin, which are only open or which have special rates for diaspora members. And we also have other types of mechanisms. For example, we have diaspora accounts, which are slightly different as well. Sorry, I have a message saying I only have 1 minute left, so I will be as quick as I can. In the last one with the bonds, we have the green bar is the highest, which is the public sector, and that really distinguishes it from the other types of mechanisms we have here. So when we say the public sector, this is perhaps going to infrastructure projects, investment in public institutions for those infrastructure projects, for example, as Sona's already mentioned, or is going to impact on the balance of payments of the national accounts of the country of origin as well. The point here of taking such a broad look, what this series of charts really shows us is, from a governance and from a development perspective, if you wish to promote a certain type of mechanism, the one that you choose will depend on the audience that you're trying to do it for and the outcome you're trying to achieve. If you're going to try and fund SMEs in a particular in a particular sector in your economy, you need a different mechanism compared to funding, for example, a massive infrastructure project that requires billions of dollars. This is quite obvious, but here we kind of map out and the evidence is quite clear. If I could go to the next slide just very quickly, please. Just quickly touching on the knowledge and the non-financial mechanisms as well, which Sona and Stephen have already slightly mentioned, and I'll be as quick as I can. This was the largest group of different initiatives that we were able to find. They're the most widespread for various reasons, as Sona has already touched on. What we should note is that knowledge transfers don't necessarily exist in absence of a financial transfer. In many cases, they happen alongside one. So for example, we have mentoring programs where funders might be mentored on how to choose who to invest and where to direct your funds by diaspora members who have tacit knowledge and linguistic capability and understanding of the business sector in the country that they're originally from. We can also have mentoring for the receivers. So from experts, professionals in countries of residence, for example, in the United States, in Silicon Valley, they will networks and partnerships in their country of origin to help that sector there to be prepared to receive money, to be able to manage that money, to know how to manage their projects. And that in turn has a feedback loop where they're able to access funds from diverse sources again afterwards. So knowledge mechanisms, whether we're talking about the transfer of understanding about how to do business and how to get by in the different countries of origin and residence, or whether we're talking about sector-specific skills, is hugely important and not separate to the transfer of finance, but as a part of enabling finance to be gathered, affecting how efficiently it's used, and enabling organizations then to access subsequent finance as well. Organizations like Fundación Chile, for example, in Chile, which has kind of this feedback loop mechanism going on there. If I could just jump to the last slide now, please. So just to close, I think the main point that we've found with our study at the high level is we know a lot about remittances already, and we know that migrants' remittances are hugely important from a macroeconomic perspective and for the individuals and households which are receiving them. But there's a lot more out there as well. Remittances are just one of the ways that migrants and diasporas can contribute to economic development in the places that they're originally from or that they're descendants of. There are many different mechanisms as well. And this means that there's flexibility around what different organizations or governments can attempt to promote. Some have been successful, some perhaps not so. But what we put forward in our report is that these forms of diaspora investment need to be better recognized and supported. While we have a lot of data around remittances, around the flows of remittances, where they're going, how they, over time, the costs and so on, with diaspora investment, we don't have this. We have a particular approach to our study, which has enabled us to do an initial mapping, but we think there's a lot more work to be done. And these things are already happening. It's not a case of trying to channel remittances into investments. The investments are there, the models are there. We just need to find them and enable us to have the evidence to build on them. So our report has taken a first step. We defined a structured framework for understanding different forms of diaspora investment based on the assets they produce and the mechanisms that are operating. We started to systematically build an evidence base with the evidence that we were able to find, but we're sure that there's much more out there. And we've made the data publicly available. So it's in the link that I've put in the chat. And we want to hear from you if you have more information to add to it, if you have an initiative which isn't there, so that we can deepen what we've got, but we can also expand it over time. There's also more to do. We need to broaden the evidence, as we've all mentioned, because there are gaps. There's geographic gaps, there's thematic gaps, and so on. We need evaluations to know what works, because when we know what works, we know where we can repeat it and how. And all of this needs to feed into the creation of institutions and networks that will facilitate those investments happening, as Francesco was saying at the beginning, kind of the financial mechanisms which will need to be produced and the products and the regulatory frameworks to enable diaspora investment to become stable and sustainable over time. And with that, I will end, and thank you very much.
Thank you. Thank you so much, colleagues, for this, Simon, for those conclusions that really resonate nicely in our ear, in IFAD ears, because we've been advocating also from our smaller sample of projects. We did over 50 projects in 60 countries, and we get to those conclusions as well. But I think it's pretty important. And if I can make, before getting into the panel, the first reaction, particularly in your conclusion, is these are the initiatives that are out there with the right tag names in order to find them. And that's going to lead nicely into our next discussion, because at IFAD, we think that on remittances, there's 200 million initiatives, not a couple of hundred, because for each family, that's an initiative. Now, how efficiently it is obviously different. And this is just in remittances. And within that, we can cut that is a digitalization one, a financial inclusion one, and so on. But it's true. And this is very important, because the initiatives that are in your study, and this was never done, so we really appreciated what we saw in there. And your conclusion that there's a lot of good ideas sometimes and very bad execution. And who could blame somebody that tests? The bad thing that we've seen is that oftentimes we blame the migrant or the diaspora or the idea, I think. And we see it's a good idea. Sometimes there's bad ideas and actually there's the wrong conclusions, saying that it was not a bad idea, but it was just either the wrong target, which is not true, I think. So there's still a lot of work. And that was your final word, I think, to do on this. And I fully appreciate that we need to advance and on this exercise of codifying what exists out there. The myriad of initiatives are immense. And from IFAD, what we've seen, particularly with the public sector, member states, is the fruit salad that sometimes is created by mixing all this. And it becomes very complicated. If you mix remittances, apples, pears, and everything, they're all fruit, but you know, it is a bit complicated. And if you want to draw policies around that, so it needs to be, as you say very well, we need more clarity. So thank you so much. And one conclusion that leads to the panel is the following. What about what is not called an initiative and is actually now a product of the private sector? For instance, there's products that financial institutions right now in Southern Europe have created for diasporas for the 1960s. They still acting today. Remittances are for free, but they don't call it an initiative. It's just a product that is out there that addresses remittances. Portuguese, Italian, Spaniards abroad that can send their remittances for free back home. That's a remittances initiative in a way that they so mainstream so well that it's not even called like that anymore. And that, I think, it's what we would love to see for the rest of the world, for the 200 million migrants sending to 800 million people for the next generation. And that leads me to that, the private sector. And we realize pretty soon that they are the key. This is why the panel that we have today is composed of them, because we realize that from the nature of the institutions of the private sector is there's a pitch, and it's the first round of discussion. I'm going to ask them, what is the pitch that made you enter into this? And the second is, well, is it viable? Therefore, can you scale it up? Will you scale it up? Because if all the private sector acts in unison like this, then it becomes like any other product. And maybe there will not need for webinars like this in the future, just maybe to make it more efficient, but that's it. So before we get to that day, we need to get examples and inspire others. And I will start with this round with Nika. You know, MFS Africa, as you say, I mean, your catch line, I believe, is making payments should be as simple as a phone call. Well, in that pitch, how do remittances fit? Can remittances help you in that pitch of yours? And it would be great if you can do that pitch back to us in a way, to understand the opportunity that remittances represent to your business and the viability of it at the end of the day. I will start with you, and you have 4 minutes.
Thank you so much. Thank you so much, Pedro. So this is Nika Naghavi, and Pedro introduced me in the beginning. For those of you who don't know FS Africa, we are a Pan-African fintech company. We operate the largest digital payments gateway on the continent. And we believe that in a world that fragmentation is holding us back, building a network of networks that provides convergence and interoperability at scale will mobilize borderless possibilities. As Pedro mentioned, our mission is to make transferring money as internationally as easy as making a phone call. And we're getting there, but holistically, the whole industry is not there yet. So today I'm going to focus on digitization of remittances and how affordable digital remittances contribute to many other development goals such as financial inclusion, economic growth, job creation, women's economic empowerment, and health protection. So before I start talking about our business, I just want to provide the context, because in the developed world, the backlash on technology sector continues to grow, especially around fake news, ideological bubbles, unethical use of data, which often makes it very difficult for people like us who work in the financial services to make a case for technology and digitization. So as I mentioned before, context really matters. So what I want to emphasize on today is the transformational role that technology has played in enhancing financial inclusion in Africa. Over a decade or so ago, the only viable option for remittances across Africa was pay and pray. In a sense, using informal channels and sending money via individuals or buses who were commuting across borders. And then the mobile money revolution happened. So mobile money started in Kenya in 2007 and then grew into this global phenomena. And already, and today, if you look at the mobile money industry as a whole, there are 1.2 billion mobile money accounts, and more than 500 million of these accounts are in Africa. And for those of you who are not familiar with mobile money, because again, going to the backlash on technology, inclusivity really matters. So mobile money is a technology that enables individuals to store value in a virtual account without having an existing bank account or using mobile internet data or smartphone. So for you to have a mobile money account, you don't need to own a smartphone. You don't need to pay for expensive mobile data packages either. It's all based on GSM technology and using basic and feature phones. And so now looking at where we came into the picture, at MFS Africa, we've been driving the next steps of this revolution. So mobile money started in 2007, and around 2010, we started operating, and we played a key role as an ecosystem orchestrator across the continent. So we built this network of networks that connects over 320 million mobile money wallets across 37 African markets. And in doing so, we have enabled millions of Africans to today to transact and exchange value with anyone else in the world and across Africa. Though we are a B2B company, we are customer-centric and obsessed. For instance, when COVID happened, we saw firsthand the accelerated shift in behavior and towards digital. We experienced significant growth in the total value of payments that were processed through our hub and platform through digital channels on a daily basis. And for example, the year of COVID, we saw family remittances from US to Africa flourishing and increasing by threefold in value. So we've seen that, but also we know that the ability, and this is part of what makes us unique, is that we are a B2B company. We bring in MTOs and other global players closer to recipients. But we have a lot of market know-how and knowledge. And from our experience, we know the ability to receive funds instantly and securely, and being able to store them in a digital wallet virtually brings a lot of benefits about to remittance recipients. So I'm going to mention a few just for those who are not very familiar with mobile money enabled international remittances. Through these digital remittances, what we can see is increased convenience and reduced opportunity costs for both the diaspora and the families back home. Often they have to travel and be away from money generating activities to go to a brick and mortar shop to send money or receive money. And going digital removes a lot of those barriers and enables the MTOs and money transfer operators to push back some of those cost savings into consumers. And also, as a result, there's like lowered cost as well. So digital, we've seen mobile money and digital channels consistently showing up in World Bank reports as the cheapest channel compared to other alternatives and legacy models. And for many recipients, digital remittances acts as a gateway to financial inclusion, through which they can create a digital financial record or a credit history. Which brings me to my last point around the ecosystem. So in pioneer mobile money markets such as Kenya, Tanzania, Uganda, and Ghana, the ecosystem is strong. And when people send money, let's say from Europe or US, and the recipients receive them in their wallet, they have so many options. They have the options to use the same funds and purchase daily essentials, from supermarkets and big chains to small, small markets and food stalls and markets. They can also use the fund to pay for their utility bills and for their school fees of their children. And they can also invest it in the local economy or save their remittances that they receive. However, in a lot of markets that the ecosystem is not strong, the options are limited, and converting back the funds to cash is the only viable avenue. So as an ecosystem enabler or orchestrator, we are invested and interested in going beyond remittances and ensuring that all the pieces of puzzle come together. There are options available for recipients, whether it's cash pickup points or opportunities for dispersing loans, for enabling recipients to save that funds, or investment opportunities, or linking remittances to insurance. And we are enabling this through a series of investments. And Nika, I'm done. Okay. My 4 minutes is over.
By far. But go okay. Conclude.
So yeah, I was just going to say we're not building everything ourselves, and we're enabling this through a series of investments and acquisitions in other African startups who can bring all the pieces of puzzle together. If you think about this as the term that everyone uses, embedded finance or Lego banking, we want to ensure that we have all the pieces of Lego together so that the whole ecosystem is stronger and everyone benefits equally. So thank you, Pedro.
Thank you. No, and I did let you actually answer the second round of questions, because you brought it to the scaling up, to the viability. How do you see it? So thank you for that. I think it gives us a big picture. And maybe I'm going to suggest to the panelists that we do that. Then you pitch on how you see it forward, so you can continue your narratives. And then we might do the last, 10-second question is 3 words that you think, what are the 3 key areas? But thank you for this, Nika. I think you extrapolated very well the type of issue, the business opportunity, and how we can take it to the next level. Thanks to the digitalization at IFAD, we believe again remittances and diaspora investment are not that response, but are really a tool that spearheads the change that we can have, be it on remittances for digitalization, be it through the financial inclusion force that they have to give access to even those that don't receive remittances, those that don't have diaspora members abroad. And that's where we see the development impact. And in in that regard, still on remittances, I want to go to Michael. Michael, you know that I believe that remittances are the biggest insurance individual plan in the developing world by far. That's it. And it works. It works every single time. But now, where's the pitch? I know how the pitch worked for you, but where's the pitch to make it more efficient and basically closer to the insurance as we see it? How does that transpose? We need the big insurers to believe in this, to see these customers. Why hasn't that happened? Is it happening now? And how we make sure that it will actually happen much more in the future? You have the floor, and I will stop you before you're hitting the 10.
Pedro, thank you very much, and thank you all. This is a really interesting discussion for me, and I'm thrilled to be part of it. And I'm also thrilled that I'm here to talk about insurance, because when we think about remittances, and we think about investments and diaspora investments, a critical link that we seem to keep missing is the insurance, because there's only so much money, right? If we're talking about the migrants, we're talking about the diaspora, they're sending money home to help take care of mom and dad or nieces and nephews or kids, to keep the family structure going. And so that's the $200 that you mentioned before, Pedro, $200 a month coming back. But then as soon as something happens, then those migrants, the diaspora, has to send money back again. Dad's in the hospital, money. There was a drought, money. There's this problem, money. Everything is coming back. All that money is a very inefficient mechanism for getting people to get coverage of those issues back in the home country. And when we're spending a limited amount of money on these inefficient mechanisms, then we don't have the money to make the kinds of investments that we need in the future. So all these pieces come together. If you think about migrants and the diaspora themselves, this starts out as a family economic strategy. The economy of the home family and the migrant are tied together, the migrant and the diaspora, no matter how many generations often. Okay, and frankly, I'm not talking about, there are clearly very rich diaspora, and I'm not talking about those. I'm talking about the majority, the ones that are sending the $200 every month, right? And so if we can find better ways of getting the diaspora to fund these events that they become responsible for, then we can have a better pool of funds, a more consistent pool of funds to provide for investment. And you think about the family at home and the responsibility of that migrant. You think that the migrant's paying the basic funds every month. The migrant is paying the events, and then whatever's left over is for the investments. And so the more we can leave for the investments, that helps to create the sustainable development that I think we all want, because then they're able to make those effective investments. So we're working on programs now at the Microinsurance Center at Milliman, and there are others too, working on programs that are trying to link remittances with insurance products. And linking these products, we're doing demand research on both sides. Now I'm going to get a little into the pilot testing, if that's okay, Pedro. We're doing demand research to make sure we have what the different markets need, because really the incentive of the incentive for paying for insurance products is from the sender, the migrant, because the person at home, the family member, they already have insurance. Their insurance is the migrant. And so we have to be able to fix that and help them with a very simple mechanism. As Nika was saying, we need a simple combined mechanism that helps to get insurance products to these markets. And this actually, the pilot testing is, and the scale when we get to it is actually very complicated, partly because of what Mohammed said about regulations. Right, we've got regulations in the receiving country, regulations in the sending country, and trying to work through all that in a way that makes it so that we can have this kind of a smooth transaction is actually very much a challenge.
Can I ask you a question on that? So we're ready for the second round, since we're doing all in one, because that leads to the scaling up, right? So the regulation keeps coming, and we're all working very hard into this. But it's a natural barrier. It's not unbridgeable. It's a necessary natural barrier, I would say, to come into this. But how feasible do you see it? I mean, we understand, we can imagine the type of work, but what do you think is required right now? What are the elements, the triggers that will facilitate passing that barrier, the regulatory barrier, the onboarding, even marketing-wise, or even financial education or insurance education from both customers? How do you see that?
I'll tell you straight, in the work we're doing, we're having some trouble in the US. One of our corridor, our first pilot corridor is in the US. And we're having some regulatory trouble here, because as soon as we start marketing a product from another country,
Yes.
then they're telling us now that that other insurance company needs to be somehow registered in the US. So we're working on ways of getting around, and everything, all kinds of crazy things, from using fronting insurers to one attorney suggested that we try to do something with the US Congress to get them to pass a thing. And you can just imagine what that would be like. So what we're trying to do is figure out ways to make this happen, because this is a challenge. And I think, the issue is, I've been working in microinsurance for 25 years, and microinsurance is always, here's a roadblock, how do we figure it out? Here's a roadblock, how do we figure it out? And also one of the key things is, we can make the pilot that we're doing now work, because I can maybe get the insurer on the other side to do some things in the US. But in 5 years, we're going to have 50 insurers, 70 insurers, because every country we're going to have different insurers. I can't do this 70 times. So we are really working on how do we make this not just an efficient transaction now, but over time. And so working on that end, also working with the regulators in the receiving countries, and then how we structure the process, right? We're not buying the insurance in the US in this corridor example, but we have to buy it in the receiving country. And that helps eliminate some of the regulatory issues. So it's everything from the structuring, how we do the marketing, who we market to, and how we deal with the larger regulatory issues. And this is, it's really a complicated play, but I think I'm confident that once we can move beyond this, then we can replicate those mechanisms as we go. So replication in other countries should be much more efficient than the pilot, which I guess is always the case.
And that would lead, basically, at the end of the day, big business, right?
Yes, huge business.
If we need to reconsider a career change, I think it seems like for some time it will be a safe place to look into. I mean, all the figures are here to show it, definitely.
You can come and work for me, Pedro.
Okay. Well, there's all the elements. I mean, and they're doing it. So thank you so much for this insight, Michael. I know we could stay all day talking about that, actually more than that. And we're working together with Project. It's not a surprise that all the panels that you have here, we are working with IFAD. This is why we thought it would be super interesting to bring it to you and share some of the lessons learned so far. And we've seen digitalization, we've seen a financial product, and at the heart of the linkages of remittances and development were financial institutions linking this with financial services. And remittances, money transfer companies were just born out of the deficit from financial institutions dealing about this in some markets. As I said, in Western Europe, in Southern Europe, actually, it became so traditional that now they don't even call it remittances. But what we saw in Moldova here was a country, a lot of people benefiting with this, a knowledge of financial services, yet a disparity between the two. And I think, Alina, you can tell us maybe the pitch that through this project we were able to link remittances basically to financial institutions that otherwise were not providing this, and from that now working, what are the perspectives into bringing this as a normal thing within the financial institutions? I think this is what every financial institution wants to hear. Is it efficient? Is it worth it or not? So could you do us your pitch and basically on this on your time? I'll give it over to you. Thank you.
Thank you, Pedro. So just allow me to say some context that stand behind the project itself. So first of all, Moldova is an Eastern European country that highly depends on remittances. The remittance share in our GDP is at least 20%, but this if we consider just the official data. We know that more than half of this data is unofficial. So it means that a lot of remittances come into our country not through official ways. And this shows two things. First of all, we have a huge disadvantage because a lot of the money an inflow, an injection of money, a monetary, let's say liquidity coming to our country in unofficial way. And second is that a huge dependence on remittances. That number shows usually goes into consumption, unknown not into the entrepreneurship or development, and mainly in rural areas. And that was our objective through this project. So what we did, and we managed to do it, I think, pretty successful, is that we have tried to channel the remittances through credit unions in Moldova, credit unions that are not banking institutions, but which are mainly present in rural areas of Moldova, and then the linkages with the financial services for the rural population. So connecting Moldova's credit unions to the international transfer systems, which we did through an MTO, or licensed payment provider, we call here like this. We managed to put it a kind of a first building stone on the road towards few important advantages. First of all, is access to remittances in rural areas, enhancing rural entrepreneurship in detriment of direct consumption of the money that comes as remittances. Then the financial inclusion, that this is the second stage of receiving the remittances and then fostering it into the development of the rural area and not into the simple consumption. And in general, the overall conceptual deep rural financial transformation as a structure. So just briefly to try to share our experience in implementing this project. So I have to reiterate that the whole saying that theory differs a lot from the practical appliance. Among the most important challenges, of course, was the COVID restrictions and the resulting consequences. So nobody thought that before starting the project, we'll face that kind of impact on the whole implementation. But besides this, we have to solve different legislative and regulatory implementation issues. And what is more critical at the initial stage is to have alternative preconditions. All the time you should have different variants. You should all the time understand that if that could not work in a specific circumstances, considering that all the time everything is changing. And now, year by year, we see how fast everything, economic, political, social, different issues are changing very quickly. So that you all the time have to anticipate and have different alternatives. We were lucky because I represent the supervisor from Moldova and the regulator in the same time. And why that was possible as a regulator, of course, we just being an implementation agency here of this project, we just changed the regulation during the implementation project, depending on what we saw that would be the most efficient and effective issue. Then another point is to reconsider the importance of the human factor, mainly the change of the old habits of the administrator, of the credit unions, and of the financial education in general, and the implementation of new innovative visions and skills. It seems it got to be really a challenge while implementing, because usually in rural areas, remittances come from migrants, and migrants are usually young people that work in Europe and send money. So here we worked a lot with more, let's say, old people, and the change of vision and they're not so flexible. So we usually have to work harder to convince them in different issues. And one important issue was to explain and convince them that it is not simply only about the remittance transfer itself, but more about the main services they could provide and that could amplify, and that each person that step into the office of the credit union to receive the remittance should be viewed as a potential client for a loan or savings. And that the progressive growth of the credit union's activity is directly correlated to the remittance transfer itself. So one resulting detailed conclusion is that for this reason, credit union, we enhanced at least credit unions to absorb the cost of the transfers of remittances and make them for free for their clients. So we had done a different analysis and proving them that in fact it is not so costly to make this remittance, but you could cover these and catch each client and promote him the products that you have, savings, loans, and other products that you could provide, even insurance. So additionally, and to understand this idiom, it took some time for the piloted credit unions and selected, and now we understand that this time is needed for them to be implemented and to achieve the objectives that we had established in our project. And additionally, the last one, this is about training, and once again, training is never enough. So it's not only about the staff of the and the key staff of the credit union itself, but also the financial education of their members, which are their clients in the same time. So probably I'll stop here and not talk about scaling up, yes, if you have some time. Sir, we can hear you, Pedro.
Actually, on the contrary, you have another 3 minutes, so why don't we bring that aspect of well, okay. You just laid the ground for the scaling up. How viable, how possible is that given the challenges that you just mentioned?
So now we are at the stage that scaling up is really a priority for us because we already did the most complicated, tough work. Now, considering our situation, we understand that we could at least double or triple what we have by just making other credit unions eligible to be part of this from one side. Mm-hmm. And the second part is to connect to other MTOs or payment providers that are connected to the international transfer systems in order to scale up. Also, I just want to sorry that if I'm speaking.
Nika is nodding, huh?
Sorry?
Nika is nodding.
Yeah. Well, but that's true. That's what we have now. And another, what I want to point out is that now we also work with the system of credit union system on the strategy of development as being really implied into the whole developing strategy for the credit union system. What I pointed out is that we have to reevaluate the possibility. Probably that would not happen in 1 or 2 years, but maybe in 3 years, we could in generally institutionalize a separate for the system payment provider that could help and be more efficient and oriented into mainly clients that are people from rural areas, from the credit unions. And that would definitely scale up all the results that we have achieved now in a very limited time for 30 credit unions that now are activating in Moldova. And additionally, the products, as Nika said, well, digitalizations, we are already late with digitalization in our country. And one maybe very short-term issue would be to scale up this type of remittances and to, well, type of mechanism. We should digitalize. We should go into financial inclusion by digitalization using mobile phone and all of this. This is like now. We're very good in everything related to internet and very fast in this, but in digitalization not so much. So that could be also an issue to scale up what the results that we had managed through our project.
Thank you. That was fantastic. I mean, now you understand why you're on the same panel. That I think is the whole point. And this could be happening completely on the side without you even knowing that there's an International Day of Family Remittances, which, by the way, you just became ambassadors, because that's exactly what you're doing. But it's true. And this is how we need to link this agenda. I mean, the role of the private sector is key. We have 12 minutes left, but I want to give my 10 minutes now to Mamadou. I will quickly combine. There's some questions in the chat, and I would really want to thank our panelists that have been answering those. There's some questions where I would really invite our participants to go into the website, because other eGFRIDs have addressed this. And I really invite you to follow to the next sessions. But I'm very glad that you're asking the questions and your interest has risen on this. But we've talked a lot about remittances. Just in that segment of this myriad of contributions, the remittances part, the access and use, just how enormous it is just on that track. There's the other ocean on the other side here is the diaspora investment. And we haven't talked about that. And Mamadou, on your shoulders rest now to our audience is an understanding I think our colleagues from the EC have showed various mechanisms that exist. We went from the one-on-one hand-carried diaspora investment to a bond, passing through crowdfunding. But I think the pitch here is, can diaspora impact investment, is that a reality as you see it? Because, do you believe in that as a EAP organization doing that? You're not public sector, you're private sector. What do you see? What convinced you? And second is, what do you see a future on that? And if you can really give me the 1, 2, 3s of your preferred priorities in order for this to move and change to the better, of course. So I'll give you the 10 minutes, and then we'll see how we use the 9 minutes left, because it's 3:20. So go ahead.
Thank you very much, Pedro. Can you hear me?
Yes, very well. Yes. Thank you. Go ahead.
Great. I'm very pleased to be part of this panel, and what I heard is very, very interesting from all the panelists. So we at INP, we have been investing in SMEs in Sub-Saharan Africa, impact investment, using equity and quasi-equity to address the missing middle of funding of the SMEs. Basically, we bring patient capital to the SMEs from 50,000 euros to 2-3 million euros. And we also support these companies to get sustainable, profitable, and have impact in their country. We are now, the reason I am here is we have been working on structuring our investment vehicle made and funded, created by the Malian diaspora. And the idea came from mutual reflection from INP and IFAD. In the context, we have been structuring an investment or local investment vehicle in Mali, dedicated to invest in SMEs in Mali, in equity and quasi-equity, from basically from 50,000 euros to 500,000 euros. And what made us go through this project is we identified the diaspora has a very good opportunity to bring money into the SMEs, but also skills into these SMEs. And the main objective was three, and I have been three. One is encourage these diaspora members to invest and hopefully also create SMEs in their country of origin, get them familiar with investment in SMEs, professional investment in SMEs, and create a close link between these diaspora members and the SMEs, because we see many advantages to do this, because the diaspora, basically these SMEs we're funding are, even though they are formal, they are not well structured, and they need support, and they need funding to grow. We through legal and market studies, we have on the way to we are formalizing now this investment vehicle with Diaspora members who have this type of profile. They are executive and middle managers, entrepreneurs in various fields, in finance, in information technology, and in communication and media. And they are mostly educated people, and they have average income which are higher than what we can see in the in average from the people from the African diaspora. And even though these people have low financial literacy, we found that some of them have also already started investing in SMEs in their own countries, not in a professional manner, of course, but they did it via loans and equity, and their motivation are to contribute to the development of their country. So they have an impact investment approach, but also they expect financial returns. So we went through a practical approach, have members of the diaspora interested in this project, and advise them to choose the right structure, the right tools to create and take into operation this investment vehicle. So the first phase of so we have now around 10 diaspora members who will together bring around 100,000 euros. And the first phase is the objective is to make them invest in Zira Capital. As a reminder, Zira Capital is the local fund we have been structuring in Mali, and also make co-investment with Zira Capital. And this is to make them familiar with the professional investment approach we have at INP. And the investment vehicle will also, by its members, bring support to the SMEs with monitoring advice, but also bring a network which could create business opportunities for the local SMEs. In this first phase of the project, of the investment vehicle, we'll have, let's say, funders, these around 10 people, and that they will be joined very soon by dozens of people to grow the financial capacity of this investment vehicle and make more investment in 1 year. And then this will help this investment vehicle to have a track record and then get familiar with the professional investment approach and the support of the SMEs in Mali. So this is the first phase, which will last around 2 years. And we will go to the, let's say, the scaling up lever. The ambition is, the Diaspora members have is very huge. And because they see that many Diaspora members could be interested, and whether they are individuals or institutional, because in these investors from the diaspora, we also have institutions, mainly private companies funded, created by diaspora members. And in this scaling up phase, let's say the phase 2 of the investment vehicle, which is called Chiwara, the name of the investment vehicle. The diaspora members will go and search for more research, more financial research from institutionals, but also from more diaspora members and get hundreds of diaspora members involved in this vehicle. So here we'll have two different challenges. The first will be most of the diaspora members do not have enough financial literacy to understand all the issues from investing in SMEs in Africa. And the second one will be regulation. In the first phase, we will be on the radar of financial regulators because we will start with a light structure with less than 150 people, investors. So we would create what is called in France SAS, Société à Action Simplifiée, which is, let's say, a quite flexible structure that we could use and invest in SMEs. But in the second phase, if we have hundreds and hundreds of people, we will be will need to have accreditation from the financial authority. So
I'll ask you to conclude on
yes.
your main pitch right now, because we came to the end. So
okay, this is a great. There is a great opportunity to scale up because we have many people interested, but to chase this opportunity, we will have to bring mechanisms to make them more financially literate. In this way, we will set up an association which will organize events events on investing in SMEs, and we will make entrepreneurs come and testimony and bring the field vision to the investors. The second mechanism that we would like to bring is the risking mechanism. Actually, concretely, that could be a first loss guarantee mechanism. When we are partnering in this type of investment, there is a need to have blended finance. So this first loss mechanism will help us de-risking the investment from the diaspora, and have more diaspora members investment. And in this third phase also, we will open to other African diaspora and diversify the investment risk related to one country of investment. So we will have more countries of investment. There will not be only Mali, but other countries to diversify this risk, because we are the investment vehicle will operate in fragile country, and there is a need to diversify also this type of risk.
Right.
Thank you.
Thank you so much. And what you just basically mentioned is the modeling within the scaling up approach, a modeling that works. What are the ingredients that are needed in that as a push mechanism for this to be more monnaie courante, as we say, usual, yes, some sort of de-risking incentives. And we have seen this. But what I think is very interesting for the audience, and I think the objective here has been attained from the presentation to this, is that we cannot get a satisfied audience after this. We can only have made them more interested to get to know more, because I think we opened some eyes, I hope. But this is what we reach. In the example you just mentioned, Mamadou, this is a very specific niche. If we categorize like we do at IFAD, on the diasporas and migrants from M1 to M4, Here, we're talking a niche of diaspora/angel investors that want to do that, that can have a pull effect to other diasporas and maybe other models that can be, the opportunities are immense. And that's why we need more, the modeling. Who are the key partners? It's not just governments that need to come and set up all these things, or donors or international organizations like us. We come, the funds run out and it stops, and then everybody blames the diaspora or blames the bad idea, when it's not. The need is there. The diasporas, as you say, are asking for this. Interesting, they're asking for this where Mali, where every international investor is actually not investing in Mali right now. So that's interesting, that counter-cyclical investment cycle that therefore deserves its own view. Governments still have to see this, and more importantly, I think private sector. And I think IEP for taking the lead on that. If you're first, you will get the first fruit out of this, but hopefully competition will follow suit where these markets exist. Colleagues, I want to thank you very much. We are already 5 minutes past. I allow myself this because a lot of questions have been answered online as we went. I'm going to ask the audience, if you have further questions, please keep sending them. Not when this meeting is over, but with the email address that you received the invitation from. We're going to be posting all this on the eGFRID website, and the answers will be there, and any additional questions that we have, we'll kindly ask the panelists to answer on this. So I wanted to thank everyone, and you can see now on your screen what the email address is. I hope we really generated interest. I don't think we just scratched the surface. We were still in the surface, but we went deep in some aspects. That is just to give you how not only the scale, but the scope as well of the possible interventions on this. I really want to thank our colleagues for the research that has been done. I think coming from respectable institutions this time and non-biased, I think it's very useful. It gives a perspective on what exists out there, and therefore the opportunities still with their challenges in to address this and do more. So I will invite you all for the next eGFRID. If you're here, you've been registered, therefore you will get our next invitation for the next topic during 2022. I will just leave you with the word that the IDFR campaign, the International Day of Family Remittances campaign, is ongoing still for this year. You can be an actor on that from your interest, your perspectives, of your thoughts on this. This is a United Nations General Assembly International Day. The campaign will run all day, but if you're interested in contributing to this, as our colleagues today have just done, please let us know, and we can guide you on how your views can be shared for the importance of remittances for 1 billion people. So thank you so much for all the participants, the panelists as well, the presenters. We wish you a very good rest of the day. For those that are still maybe in the morning, the day for us, and the evening, have a very good evening and good night. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you. Bye-bye.
Thank you very much.